Did you know there is no such thing as a safe bank? In fact, every bank, always and everywhere, is always at risk of failure. And I'm going to prove it to you by showing you that it is literally baked in. It is inherent to the way that banks operate and how they actually make money. If you don't know who I am, my name is Joe Brown, and in 2019, I quit my job as a stockbroker so I could start Heresy Financial, teach people how economics really works so that you can make more money investing. And in order to understand why banks are always at risk of failure, we have to go all the way back to the beginning, and I mean the beginning of how gold became money. And I promise this is going to explain how banks work and why they're so risky. So this is a fictional tale, but if we go back logically to the beginnings of money, we can imagine a couple of people in a small village that one person makes shoes and one person has cows and one person has some fruits and veggies, and they want to do some exchange with each other. The person who makes shoes wants some cheese, and so he goes to the farmer and says, "Hey, I'll give you some new shoes if you give me some cheese." And now that works out great for them and they have their little exchange. But there's a problem that happens the next time the shoemaker comes over and he says, "Hey, I need some more cheese. Can I make you another pair of shoes?" And the guy's like, "Well, no, the pair of shoes that you made me still work. I don't need more shoes." So then he's like, "Okay, well, what do you want then? What do you need?" The guy's like, "Man, I could really go for some apples." So the shoemaker has to go to the apple farmer and say, "Hey, I'll give you some shoes for some apples." And then he takes the apples back to the dairy farmer and says, "Hey, here's your apples. Can I have some cheese?" Well, obviously, this can get extremely complicated very quickly. And once you have more than 4 or 5 different people, it's just not possible to go through all of those levels of exchange just to get the one thing that you want. So throughout history, what ended up happening was some goods arose from the rest as having value simply because most people would value them because they could be exchanged for other things. Throughout history, this has been things like salt or rice. It has been cows, seashells, but very early on, gold actually arose as that one commodity, that one item that most people would continue to value simply because they could use it to exchange for other things that they value. This happened thousands and thousands of years ago as gold arose as kind of that dominant form of money around the world. And what's interesting is one of the reasons why gold performed that role of money so well is because it kept its purchasing power due to its scarcity. And in reality, that purchasing power has even persisted until today. If you look at things that you can still buy today that people were buying a couple thousand years ago, the price as measured in gold has stayed relatively consistent. Things like the cost of getting a haircut, the cost of employing an army captain like a Roman centurion, the cost of even custom tailoring a 3-piece suit. As long as technology has not made it cheaper, these prices in gold have stayed relatively consistent over time. And that's one of the reasons why people liked using gold as money, because they could just sock it away and they could save it. And even if it took them 5, 10, 20 years before they spent it, they knew that their wealth was still stored up for them. But gold actually worked a little bit too well for this function. And I'll explain what I mean. We all know how inflation works, right? You see a central bank like the Federal Reserve print $3 trillion in 2020, and suddenly out of nowhere that nobody expected, we have record-breaking inflation. And it happens all around the world. In all the countries where we've seen hyperinflation over the past couple of decades, like Zimbabwe and Argentina and Venezuela, Lebanon and Turkey, and before that, the Weimar Republic in Germany, we know that high inflation and hyperinflation is a direct result of just printing money like crazy. So you expand the money supply, well, prices are going to go up. But the key is that that money supply expanded at a faster rate than the amount of wealth. So yeah, you printed new money, but you didn't grow any more food, you didn't create any more clothes, you didn't create any more cars, you didn't get any more oil. You just have more money now chasing the same amount of goods and services. So let's flip that around. Now, imagine that you have the opposite problem, which is you have more goods and services, but the same amount of money. And let's just push this to an extreme and say, I press a button today, and suddenly for every one house that currently exists, we now have 2 or 3 houses. For every one car, we have 3 or 4 cars. For every one loaf of bread, we have 5 loaves of bread. Every single product that we want or use or enjoy, we multiply the quantity, but we keep the amount of money the same. Well, the result would be the opposite of inflation. The result would be deflation, because suddenly people will have a couple extra houses and they'll say, well, I don't need 3 houses. I want 2, so I'll sell one of them. But so much new supply will have just come onto the market from everybody trying to sell homes that they don't want or need that the price of houses will go down. And the same thing happens to everything. You have a massive explosion in the supply of goods and services, no change to the money, prices will adjust down. There's simply not enough money in the system to continue chasing all those goods and services, so the prices must go down to adjust. Now that's an extreme example that has never happened, but a very small example of that has happened consistently throughout all of human history. When money was gold, the rate at which the wealth grew, the goods and services, the things that people want and need, grew faster than the money supply did. So over time, the money got more and more valuable, which meant you could buy more and more stuff with it. This meant that over time, people stopped using gold coins for regular transactions. Maybe at one point a couple thousand years ago, you could use a gold coin, slap it down on the counter, and maybe that was just enough to buy a sandwich. But fast forward a couple thousand years, and because food production has gotten cheaper and more abundant, and the total stock of wealth has grown, but the money supply hasn't grown as much, you drop that same 1 ounce coin on the counter, maybe that's enough to pay for your entire rent for the month. And so people stopped using gold as the actual exchange product more and more over time, and they needed ways to use things for change for gold. This is where things like silver and copper came in because they were more abundant, less valuable metals. So people use those metals as change for gold, the same way that we think of like quarters and dimes for paper money today. And gold got pushed more and more into the savings or the store of value bucket rather than being used as simply the medium of exchange. Now that also meant that people needed a way to securely store their gold, because if I keep this in my home, well, somebody knows about it, they don't have the best intentions, they might break in and they might steal it. And maybe I don't have enough money to pay for some very good security, good locks on my doors, good infrastructure to stop people from breaking in. And so what I would rather do is pay somebody in order to keep it safe for me. And that's exactly what started to happen a couple thousand years ago. We saw the invention of the first bank, where people would go to goldsmiths and they would say, hold on to my gold for me, and at some point I'll come back and get it, and I'll pay you to do that for me. In return, the person would get a little piece of paper that said, give this back to the goldsmith and I'll give you your 1 gold coin back. Well, this arrangement became so convenient that people actually stopped going to the bank in order to get their gold when they wanted to make a transaction. Instead, they would just give the piece of paper instead. And those were the first examples of paper being used as money. Paper that was redeemable for gold, that people just stopped redeeming for gold and they used that paper as the money instead. Because at any point they knew, well, we can just go get the gold with it, so I can use the paper as if it's gold. At some point though, the banks realized they could take advantage of this situation. Nobody was returning those pieces of paper to redeem their claims on gold. And so the banks opened up a new service. Instead of just savings and securely storing your gold, they opened up a loan service as well. They said, hey, anybody who wants can come borrow money from me and I will lend it to you at a very cheap rate. And what most people didn't realize was those banks were lending out the gold that they had promised to keep secure. So the banks were making a profit on money that wasn't even theirs. And this was the invention of the practice known as fractional reserve banking. I have 100 pieces of gold that I've promised you can come get back at any time, but in reality I've lied. I've lent 10 or 20 or 50 of them out to other people. In this example, a worst case scenario would be somebody finds out and a run on the bank happens, everybody tries to go get their gold. And so you'd think, well, the banker can always then just go to the people that he loaned the gold to and say, hey, you have to give it back now. I'm calling in the loan. But the problem with this is maturity transformation or maturity mismatch. Basically means you have a claim to come get the gold from me on demand at any point in time. But I made a loan that I can't call back for a year, 5 years, 10 years. So I have an on-demand liability that is offset by a long-term asset. That is maturity mismatch. And so when the run on the bank happens, I have no ability to go get back those assets in order to pay back my liabilities. The bank shuts down, the banker gets you know what, or run out of town. Now you'd think that would have been outlawed, but it wasn't. In fact, it was nationalized. And about 300 to 400 years ago, we had the rise of central banking, where governments looked at this practice and they said, well, that's bad, but we don't want to outlaw it. We just actually want to do it ourselves. And so they invented the central bank and they said, if anybody wants to participate in fractional reserve banking, you can do that as long as you do that underneath us, the central bank. Now, the rise of central banking around the world caused crisis after crisis, from the Mississippi bubble in France 300 years ago to the Great Depression and the first forgotten depression right after the start of the Federal Reserve in 1920 and 1929. But essentially, it's the same exact thing that we've been talking about this entire time. You trust your money with the central bank, but in reality, they've made far more loans than they actually have on deposit, and that creates instability in the system and eventually causes a bank run. Fast forward to 1971, when Nixon ended the gold standard. What really happened there was just another run on the bank around the world. The Federal Reserve at that point was operating like the bank for the entire world, and dollars were redeemable for gold, just like the banks of old. But the world realized that the Federal Reserve did not have anywhere near enough gold in its vaults in order to redeem all of the dollars that the government had printed and that were in circulation. So the rest of the world started to run on the bank, started handing in their dollars to get their gold before it ran out. And guess what? It ran out. We entered the gold standard. And since then, the entire world has been a paper money only standard. But just because all money everywhere is paper and today digital paper, that doesn't mean it operates any differently. You give your deposit to the bank, and what they do with it is they loan it out to somebody else. And when they loan it out to somebody else, this is the fun part, that somebody else ends up depositing that money in another bank account. And when that money gets deposited in that bank account, that bank loans it out to somebody else who then ends up depositing it in another bank account. Whether you swipe a credit card and that new loan is dollars being deposited into the grocery store's account, and then that money gets paid to an employee into their bank account, and then that money is loaned out to somebody for a mortgage to buy a home, and that money then gets deposited into the home seller's bank account. Every single dollar in the system has just been loaned into existence. Now, you're probably sitting there thinking, well, this is massively dangerous and should probably cause some instability. And you're right. That's why since 1970, there has been a massive explosion of hyperinflation and bank failures around the world and massive economic crises. Take, for example, the savings and loan crisis that happened in 1980, or the great financial crisis that happened in 2008, or if you want to bring it home a little bit closer, we can take a look at the pattern, at the waves that bank failures come in, and this is directly from the FDIC's website. In 2005 and 6, there were 0 bank failures, followed by a big spike in bank failures with a lot of money lost, and then the following years had more and more smaller bank failures with less money lost. Following the exact same pattern in 2021 and 2022, there were 0 bank failures, followed by 2023 with massive assets lost from a few bank failures, which would mean over the coming 2 to 3 to 4 years, we're going to see more and more small bank failures with less money lost. At the foundation of this, the reason today why banks are in crisis is the same reason why they're always and everywhere in crisis, because your dollar that you deposit with the bank is not there. They've loaned it out to somebody else. And if you and everybody else who made that deposit try to go get your money back, it cannot be gotten. Maybe you're first and you get your money first, but at some point down the line, the money is already gone. But you ask, why in the world would there be a bank run? Is there anything happening today that could cause failures like this? And the answer today in 2024 is the commercial real estate crisis. This year alone, about $1 trillion worth of commercial real estate is getting rolled over or needs to get rolled over. It is maturing. And that means that a bunch of commercial real estate owners have a bunch of debt on that commercial real estate. But all of that debt is maturing this year. Not all of it, but a lot of it. The thing is, though, they don't have the cash to just pay that loan back. What they've always relied on is the fact that they can get a new loan in order to pay off that old loan. The problem is interest rates are way higher now than they were when they originally got that loan, which means a lot of commercial real estate holders are sitting there looking at getting new debt that will bankrupt them because it's too expensive and their building is not profitable enough and cash flowing enough to pay for that new debt, or they'd have to sell their building at a massive loss and they'd still owe money on the debt. We have a massive commercial real estate crisis right now. It is mostly focused on office space. It's not all commercial real estate. And the banks that are in trouble from this are mostly small regional banks. It is not your big banks. It's not Bank of America. It's not Chase. It's not Wells Fargo. Although the only reason you should be with Wells Fargo is if you hate yourself. So if you're with one of the big banks, you really don't have to worry about this. If you are with one of the small banks though, then I'm going to lay out a step-by-step plan for you on a bunch of things that you can do to keep your savings and your cash, your money safe. Number one, you should be having some of your savings kept in gold. We talked about gold at the beginning of this video. It has maintained its purchasing power for thousands of years. It's likely to maintain its purchasing power for at least the rest of your lifetime. Yes, it is a little bit more volatile. Sometimes it goes up, sometimes it goes down, but it is a great hedge against inflation. Number two, you should also probably be keeping some of your savings in Bitcoin because there's a chance that down the road, Bitcoin does become money universally. You can also transact anywhere in the world, take that wealth with you whenever you want, wherever you go. It is an asymmetric bet, meaning it can make a lot more than you could potentially lose. So I recommend having a small percentage of your savings in Bitcoin. Step number three, never, ever, ever have more than $250,000 in any single bank because the government currently guarantees $250,000 you cannot lose, which means if you have 100 grand in your small regional bank and it fails because of the commercial real estate crisis, you're not in trouble. That bank account, it'll just be absorbed by a larger bank. But if you have, let's say, $300,000 in that account, your $250,000 will be absorbed by a new larger bank, but the other $50,000 will just cease to exist. It'll be gone. So you say, well, I've got way more money in one single bank account than I should have. What should I do with all that extra cash? Number one, look for a high yield savings account. Today, there are plenty of banks that will pay you 4, 5, and pretty soon closing in on 6% just to keep your money in a savings account that you can access at any time. If you have your money in Chase making 0.01%, you are quite literally watching your money burn from inflation in front of you, and you are losing purchasing power every single day. It's idiotic. Get that cash into something that is at least keeping pace with the stated rate of inflation. The next thing you can do with your cash is put it in a money market fund. Money market funds today are very different than they used to be. Most of the cash that is inside a money market fund is invested in T-bills or the reverse repo facility at the Federal Reserve, which means as close as you can be, it's basically risk-free. It is short-term, either overnight or a couple of weeks in terms of when the money market fund can redeem it. And you can redeem it on a daily basis in a money market fund, and you're getting paid 5 to 5.5%. These are done through brokerage accounts. Do not do a money market at a bank, do it through your brokerage account. And then finally, you can go direct and buy T-bills. T-bills, I would say 4 weeks, 8 weeks, don't do anything really longer than that. You get the most bang for your buck there, very liquid. You get your money back in a month or in 2 months. And again, your annualized rate of return is gonna be 5 to 5.5%. And at this point, if you're saying, wait, I need more help, I need more specific action plans, in addition to my cash, I would like help understanding how to invest my portfolio so that I'm not losing to inflation. If the market crashes, I'm protected. I understand how to trade and be able to protect my accounts. Don't worry, you're in luck. That's what Heresy Financial University is for. It is my paid membership program where you get access to a full library of training material on everything you need to know about how to make more money and make it grow for you and protect your wealth. We do live coaching calls every single month where you get to ask any questions that you need answered. It also includes my flagship product, my asymmetric trade report. I don't want to spoil that for you. If you're interested, click on the link in the description below. As always, thanks so much for watching. Have a great day.